an acquisition specialist over at Excite Capital. I've been with the team now for a little bit over 2 years. I initially joined the team through an internship program where I first learned about the company when I was still active duty Navy. So I was an air traffic controller in the United States Navy for about 10 years, where I was actually on position in the control tower. We didn't have any planes flying, and I had a YouTube video up watching Excite Capital on this very same platform. So every first Monday of the month, we have this virtual meetup. And this is why I was first introduced to the team. So when I actually met them in person for the first time, I already felt like I knew them because of the same platform that we're on. So I'm a God-fearing, hardworking man, happy-go-lucky, always have a smile on my face for the most part. In this picture is my wife, Alexandra. We've been married for about 10 years now. And my two beautiful children, Peyton and Preston. They're the engine that keeps me going. They're the reason why I wake up in the morning. They are just the reason why I go out here and try so hard to build not only an inheritance for them, but an inheritance for their children as well. So let me move on. So, like I mentioned, I want to spend a little bit of time on this next slide before we jump into the presentation. And y'all bear with me because I just been having a heavy heart for like the last couple of weeks. While I was building this presentation, my grandmother, so this presentation is in honor of Addie Mae. We sent her home on Saturday, but I wanted to represent her in this presentation for a couple of different reasons. So I just mentioned one, she was heavy on my mind. And then two, she exemplifies and she's a perfect example of leaving behind a legacy and generational wealth. And for the longest time, I did not know what generational wealth meant. I thought that I could just work hard, make X amount of money, pass away one day, and leave that money with my children. But yes, that is a form of generational wealth, but it's limited. True generational wealth is the information, the access to information, knocking down doors, clearing the path for the next generation, being a true pioneer. So if you have children or grandchildren or great grandchildren, making their path easier. So passing that information is key. And my grandma, she could have passed away with $0 to her name, but she would have still been the wealthiest woman because all the amount of people that truly loved her and supported her. She lived to be 94 years old. She was married for 72 years of those, had 11 kids, 29 grandchildren, 57 great grandchildren, and 17 great great grandchildren. And one thing that she would want me to preach is I could leave behind $10 million, but if I don't give my children that information to be able to take that wealth and to grow it or to be able to leave it to their children, then what's the point of it? So true generational wealth is information. All right. But without further ado, let's go ahead and jump into the meat and potatoes of this presentation and let's go over the multifamily market overview and how it's currently performing. I've done similar presentations like this in the past, like breaking down like market analysis or how to conduct market research. And I always start from like a top-down approach. And what I mean by that is I'll look at the national trends, then I'll look at state trends, then I'll look at a market trend, then I'll look at sub-market trends. So like I mentioned, top down. So if we look at the national multifamily fundamentals, and some of the things that I track is the vacancy rate. So on a national level, it's at 8.7%. Rent growth year over year is about 2% nationally. And all of these data that I get is either from CoStar or Cushman and Wakefield. So all the data, all the charts that we're going to see today, those are going to be the sources of information. That's key too. You always want to be mindful of where you're pulling or what information you're leveraging for your information. So all these stats on here are either from CoStar or Cushman and Wakefield. On the screen, 609,000 units under construction. That represents the supply, right? And then the units that are being absorbed or the net absorption units is going to represent the demand. All right. And as a real estate investor, we just always have to be hyper focused on the location. So yes, understand what is happening on a national level, but equally, or if not more important, it's key to know what's happening on a property level. Okay. So over the next few moments, we have a lot of data to get through, but here in a moment, I'm going to give an actual example of how a property can outperform the market it resides in. Okay. And the last thing I mentioned was just the net absorption, which represents demand in a market. So that's a perfect segue into the first thing that I would like to discuss a little deeper, and that's how supply and demand impact vacancy rates. If I can click to the next slide. Okay. So earlier I mentioned how coming into this year, we're on track to beat a 40-year record of supply coming online and being delivered. This chart that we're looking at right now represents the number of units absorbed in any given quarter. And for those that may not know what like absorb means or absorption means, in real estate, absorption refers to just the rate at which available properties are being rented out. So I personally, for the longest time, I don't know why looking back at it, I always confuse what is positive and negative absorption rate. Like, what does it mean? And to simply put it, negative absorption suggests weaker demand. Positive absorption indicates a strong demand because these tenants in this market are actively filling up the available units. So once again, 2024, we're on track to beat a record because of all the supply that is coming to market. This chart represents the demand for that supply. So as you can see, these three bars right here represents the three full quarters that we've experienced in 2024. And then on the other hand, these that are representing like the reddish highlight represents the 4 quarters from 2023. So if you compare all of last year to just the 3 quarters of this year, demand has already increased by over 100 units. So I felt that that was very interesting. Like as I'm diving into all this data to build this presentation, there's a couple of things that I learned. But going into this year, like January 1st, when I seen that hundreds of thousands of units are going to be coming online, as an apartment operator, that's a concern because if there's an increase in supply and not necessarily an increase in demand, then what you're going to see is your occupancy rates are going to decrease, and therefore your vacancy rates are going to increase. But here in a moment, I'm going to show you how demand has been so strong that vacancy has stayed flat despite the increase in supply. Another thing I'll note, historically, quarter 2 of each year outperforms any other quarter. But this year we saw something a little differently. We saw an increase in quarter 3 numbers. And when I'm looking at data, I always say this term like men lie, women lie, numbers don't lie, but they can tell a story, right? So I just mentioned historically, quarter 2 is higher than quarter 3. And if you take a step back and think about it, in the summer months, there's more leasing activity. So that sort of drives that demand during quarter 2. But how I mentioned earlier, multifamily starting to stabilize, we're seeing an increase in demand. So let me just to continue and to drive that point home a little further. We already talked about the staggering amount of supply entering the market, but due to the stellar amount of demand, vacancy has grown flat, which is a sign of the multifamily market is stabilizing. So this chart represents the vacancy rate quarter over quarter. And as you can see, vacancy started to creep up on us, but entering this year is beginning to plateau. So that's a very positive sign as an apartment operator. And once again, the source of this data is CoStar. So here at Excite Capital, we leverage a lot of data. CoStar is probably the number one data source that I use. All right. This chart I absolutely love. We already mentioned that the national vacancy rate is at 8.7. This chart is representing on a national level, right? One reason why I love this chart is how dynamic it is. It's showing us a lot. So it's showing us the correlation between the vacancy rate and the monthly rent. So as you can see, vacancy is starting to plateau, like we mentioned. But one thing that's very interesting, ever since the pandemic, so 2020, we're seeing an increase in the monthly rent. And that's a perfect segue into my next slide that I want to dive a little deeper into, and that's rent growth. That's one market fundamental that as an apartment operator, we're always mindful of, but we'll dive a little deeper. And once again, if there's any questions, I can't actually see the chat right now, but if there are, I'll address any questions after my presentation's over with, when I can get back to the Zoom room. I put all this information on this slide for those that want to download the PDF afterwards. We're definitely going to provide it to everyone after this call is over with. But if you look at this map, this is one of my favorite maps to look at. So if you go to websites like the US Census Bureau, you can understand where people are moving to. So like, you know how the census is tracking the population? There's a strong correlation between increased population and increased rent growth and vice versa. But I don't want to, I say that to say that in markets where we saw a drastic increase in population, we also saw developers in those markets bringing on a lot of supply. So in a lot of these markets that during the pandemic, people were leaving California or Illinois or New York and moving to the Southeast. um, those same markets are experiencing oversupply. So essentially, oversupply is the developers in that area are bringing in so much supply that the demand cannot keep up with it. So this map right here sort of just represents where the population was moving from 2020 to 2022. The pandemic, as tragic as it was, it brought a lot of things in line for some people. And one of those things is people want to, maybe due to like political reasons, they want to leave a certain state, or maybe because of weather, they want to move and relocate to a different state. But one thing that we noticed is the net migration patterns. A lot of people from out west or the Northeast were moving to the Sun Belt region. And essentially what the Sun Belt region is like, if I draw like a smiley face from like Reno or Las Vegas, Nevada, all the way down to Texas, throughout the Southeast and up to the Carolinas, it forms like a smiley face. That's referred to as the Sun Belt region. The reason why I highlight this region is because it's very attractive to a lot of real estate investors. However, in a lot of those markets, you're going to see some of that oversupply. So the next slide is going to break down all the markets and how they're experiencing uh, rent growth. Give me one moment. All right. So this is like the top 50 markets that this particular data analyst tracks. On the left side, you're going to see strong demand. So these metros has so much demand that it's fueling the rent growth. So as you see, there's positive rent growth on this side. On the other side, we're seeing very relatively low or below national average. And then all these metros right here are experiencing negative rent growth, right? So one reason why is because markets like Austin, Texas, Jacksonville, Florida, Phoenix, Arizona, Atlanta, Georgia, even, they're experiencing negative rent growth because of the oversupply. Alrighty, move on. Give me one moment, y'all. All right. So I feel like we're sort of beating a dead horse with this one, but supply in the construction levels, I've mentioned a couple times already. We saw an increase in supply coming into this year, but if we're looking forward, what we can see is the construction levels are starting to drop. They're starting to plummet. And one reason for this is like just the absorption rate for like this quarter was the best ever since 2021. And looking forward, and like the next slide is really going to drive it home, is the deliveries are starting to slow down. So if you think about how long it would take to construct an apartment building, you're talking multiple years, right? So a lot of the construction that's currently being brought to market today, those permits were pulled during the pandemic or early 2020, 21, 22 in a completely different environment. Interest rates were a lot lower then. So one reason why we're seeing the supply and construction slowdown is due to we're just in a completely different environment. It costs way more to build these apartments than it did 3 years ago. So therefore, supply is starting to pull back. And that is a very positive sign that the market is stabilizing as well. Now I'm about to transition. We're still going to be talking about transaction volumes and some other things, but we're no longer talking about like necessarily the performance of multifamily. So that's why I just wanted to break this up real quick with the multifamily investing landscape. All right, so this chart essentially just shows the total sales volume. Ever since the end of 2022 and all throughout last year, I was personally tracking transaction volumes. And one main reason why transaction volume was low last year is because there was just a disconnect between sellers and buyers. If you look at the bid to ask ratio, it was essentially a buyer is willing to bid X amount a seller has their property listed for Y, there's that difference between X and Y, the transactions aren't going to happen. And one reason why I was tracking transactions is because I wanted to know what was being purchased, what markets properties were being purchased in, but most importantly, I wanted to know who was buying and who was selling. Okay. So earlier in this year, quarter two, multifamily volume popped. You could clearly see an increase between quarter one and quarter two, and it really happened with one transaction. If you're familiar with a company called Blackstone, they alone acquired over $10 billion worth of assets in quarter two of this year alone. And that's going to drive my point for this next slide, okay? So once again, transaction overall has been slow, but there's capital sitting on the sidelines. There's a lot of dry powder. You might see that in a few headlines. Like if you look at the news, there's a lot of dry powder on the sidelines just waiting. That wait might be over. Some of these institutional investors are back in the market, submitting offers, taking down portfolios. And I put this picture up because I just wanted to drive the point home. I believe everyone on this call knows the story of David versus Goliath, right? In this example, the big institutions who can control the narrative, who put out headlines that deter investors, that cause uncertainty, at the same time that they have the power to go to the news outlets to stir up these headlines, to demotivate someone from investing, they're in the same breath acquiring these amazing assets or portfolios to build wealth for them. Now, I want everyone on this call today to achieve their goals. I want everyone within our community to acquire financial freedom, to set up the next generation. And one way we can do that is by pulling our capital together as retail investors or as Davids. We could all come together to be able to buy some of these institutional quality grade assets. What we're seeing is these institutions are already doing it and they're keeping that information away from us. Now that we have the information, I personally feel obligated that I have to work hard to be able to acquire these properties. Therefore, my children don't have to work so hard. There is this one news article, I wish I would have put it in here, but it really like fuels me up. It gets me so passionate. It says that you're gonna own nothing and be happy. And then like I see an article like that where I'm not gonna own anything and still be content. No, that doesn't align with my goals. And I'm pretty sure it doesn't align with your goals either. But that's the goal. That's the plan. They're keeping this information away from us because the moment someone has the information to be able to buy some of these larger assets, that's gonna just like that transform the next generation is very powerful. And knowledge is power, and that's one reason why that information is sort of gatekept. But here at Excite Capital, the moment that we've experienced or we realize that these assets exist, that we could bring them to market, raise capital from our retail investors, change lives, start actively working towards financial freedom for not only ourselves, but for our investors. That was our mission. So that's our focus. And when you look at how the institutional investors move, some people refer to it as smart money. And all of last year, smart money was on the sidelines. Right now, we're seeing smart money come back into the marketplace. And the next two slides, I'm going to briefly go over them, but it's going to show us why these institutions are starting to come back. So one reason is pricing is starting to level off. And actually, before I talk about this slide, I'm just going to back up real quick. This slide right here represents the total sales volume. We already talked about it, right? Excuse me. If you look at this one outlying candle or bar, it was the end of 2021 going into 2022 where the most sales volumes was transacted. During that same time, if you look at the commercial property price index, so it tracks commercial property prices, it's peaked at the same point. So I'm saying all that to say that not that as an investor, never try to time the market. However, like in hindsight, we can look back and say that prices peaked at this point. They started to decline over the last 2 years, and now they're starting to stabilize and increase. Now we're seeing these institutional institutional investors come back into the market. So jumping back to the pricing appears to be leveling off. I mentioned earlier about the bid to ask ratio, where the seller's asking X amount, a willing and able buyer is willing to pay Y amount. That delta between the two is starting to level off. So what we see in this chart, this orange line right now represents the market sales price. The blue line represents what that price transacted at. So we're seeing those two figures come together. Another reason why smart money or these institutional investors are coming back into the market is because they're seeing that the market is starting to stabilize. There's this saying, survive until 2025. One of the reasons why that saying out there is because there's a few different reasons. So the supply chain, so all the markets that are, I'm sorry, all the multifamily units that are being constructed right now is going to start plummeting starting next year. And then just along with the loan maturities. So if we look back a few years ago, interest rates skyrocketed, right, at a historical level. During that time, that was another reason why transaction volume was a little low. What we're going to see going into 2025 is going to be an opportunity to truly thrive. So I'm going to change that saying, survive until 2025, and then we can truly thrive. Um, for the most part, that's it for my presentation. I'm gonna summarize it here in a bit with like my key takeaways, and then I'm gonna break down my SWOT analysis, so the strengths, weaknesses, opportunities, and things that are gonna be threatening the multifamily market. But one thing I just have to highlight is before I discuss my key takeaways, I want to introduce or reintroduce to those that may be familiar with an amazing opportunity to our community. So earlier this year, Excite Capital is in the process of acquiring Grove Park View. For those who don't know, Grove Park View is a 268 unit, truly institutional quality grade asset. If you have the pleasure to go on site and tour this asset, you'll see that it's well maintained. And I could spend over an hour talking about why I love Grove Park View, but if I could just summarize it into a few key points and then also highlight some of the things that we already talked about throughout this presentation, is going to be the strong rent growth. So we discussed that the national rent growth has been roughly like 2%, well below pre-pandemic averages. We discussed some metros are experiencing negative rent growth. Atlanta happens to be one of those metros. Grove Park View is a Class B asset in the Atlanta metro. Overall, Atlanta is experiencing negative rent growth. Grove Park View, on the other hand, is experiencing a strong rent growth. So this just highlights that you truly have to be hyper focused on a location and obviously be mindful of what's happening nationally or on the state level or the city level. But this Grove Park View highlights that you can have a asset within a market and it can outperform it. Some of the other reasons why we love this opportunity is the debt that is on it. So we are assuming a Fannie Mae fixed rate debt well below the current market rates. So Grove Park View currently has a 4.74% interest rate on it. If I were to go out there and talk to Fannie or Freddie or any other HUD or any other government backed, I'm not going to be able to get a 4% or a 5%. So like I mentioned, well below the current market rates. Throughout this presentation, we talked about supply and demand, right? All the supply that's coming to market, the demand is keeping pace with it. One reason why I love Grove Park View and the location that it's in is because it has a thriving submarket fundamentals. There's a huge demand for these units because it resides in a top tier school district. And it's only one of two apartment complexes within this market that are zoned for this school district. So you'll see families moving from across the city, across the state to go to Grove Park View to send their kids to these schools. Another reason that I would like to highlight right now is the experience of not only the Excite Capital investment team, who's going to be leading the management of this asset, but the on-site property management team. So I've probably toured over 30 apartment units apartment complexes since I've been with the team, and never have I met an on-site property management team with this much experience managing an asset. Right now, there's probably six on-site property managers. In combined, those six individuals have over 75 years of managing Grove Park View. So that experience is second to none. And then despite this being an institutional grade quality asset, it still has an opportunity to add value. So it truly checks all the boxes that we look for when we're looking for assets. The demand is there, the supply is limited. It's in a great school district. The crime rating's low. We're seeing an influx of people moving to Gwinnett County because it's in the path of progress. So if any of those things align with your investment goals, I strongly encourage you just to scan this QR code if you're interested in joining the ownership group of Grove Park View. If you scan this QR code, it's going to take you to a landing page where you can just fill out some brief information, your name, email, phone number. Myself, one of the founders of the company, or Alicia Galloway, the head of our investor relations team, will reach out to you to see if Grove Park View is a fit. So there's no obligation with scanning this QR code, but if you're interested in learning more information about this amazing opportunity, once again, I highly encourage you to scan this QR code, and then a member of our investor relations team will reach out to you. And once again, we're going to make sure that your investment goals are being met. So whether you're investing for cash flow, appreciation, a hedge against inflation, maybe you want to diversify from the stock market, or you see the demographics that I just mentioned on that previous slide and you want to be involved, scan this QR code, and I'll leave it up for just a few more moments before we move on to the next slide. But I definitely look forward to you joining the ownership group and then that next step in achieving that financial freedom. Okay. All right. This is like the last section of my presentation before we move on. And this is going to be about my key takeaways, some of the things that you can take away from this presentation, and then we'll go over my SWOT analysis. So if you don't take anything away from this presentation, looking at the multifamily market right now, there's a few different things that stand out to me. The demand is there. So the U.S. economy absorbed over 138 units in this last quarter, 133 units a quarter before. What we're seeing is an insurge of migration from the southern border, which is actually one of the reasons why we have a demand for apartments also. We have a strong labor market right now, despite the job report that just came out on Friday. We have a strong job market right now. And all of these things are just reasons why multifamily demand is there. Also, rent growth is showing signs that it's picking back up. So we talked about on a national level, it's at 2%. But I also want to just highlight, just because nationally is this or the market is this, you always want to be focused on what is my subject properties rent growth. So you can look at that, but just be mindful of past performance is not an indication of future results. But I think Mark Twain may have said it, history doesn't repeat itself, but it does rhyme. So if I'm looking at the past performance and I'm seeing that supply is starting to come down, it's just an even more reason that rent growth is going to further re-accelerate. And last but not least, all the construction that we saw come into the market this year, we're seeing a pullback. We're seeing a slowdown in permits being pulled. We're seeing a slowdown in developers developing apartment complexes for a plethora of reasons. But one of those main reasons why there's a slowdown is because just we're in a completely different environment than we were a couple years ago. A lot of the major metros in the country are in hyper supply or oversupply. So in those particular metros, we're going to see in 2025 a slowdown in supply coming to market. But all that to say, just because a market is experiencing oversupply, you could look right next door in a secondary market or a tertiary market that benefits from the major metro, and they could be in an expansion phase. So another takeaway from this, start from the top, work your way down to the property level, and just be mindful and forward looking. And multifamily real estate investing is not a get rich quick scheme, right? We're building long-term wealth, and building long-term wealth takes time. But if you look at it, if you're forward looking, 2025, 2026, and all the years after that, it's aligning to really benefit people that are hopping into the multifamily space now. So there might be a lot of uncertainty in the world right now, which we'll talk about here in this next slide when it comes to the weaknesses and threats. Let's avoid all that noise because the same people who are generating these headlines to stir up all this uncertainty, they have the power to control the narrative. And in the same breath, they're buying these portfolios. They're buying these amazing assets. So let's not worry about the news headlines or what's going on in the Middle East or what's going on tomorrow during the election. If it's not in our control, let's not worry about it. Let's not stress about it. Let's prepare for it, but let's not get down. Once again, multifamily market is healthy and it's starting to stabilize. Right now is an opportunity to get into this space and to really set up the next generation, to build that financial freedom, to be able to quit your 9 to 5. That's what this asset can do for us. And then last but not least, SWOT analysis. I didn't put any of the information on the screen, but if I'm just shooting it off, when it comes to the strength of multifamily, if I could just take a step back. Housing is a fundamental need. No matter what happens, I'm gonna need to eat, live, or I'm sorry, I'm gonna need to eat, drink water, and have a shelter over my head. So as an apartment operator, we are providing a fundamental need for the marketplace. And here at Excite Capital, we take it a step further. We identify opportunities where certain units maybe are dated, and we're bringing them to 2024 standards. So not only are we're satisfying a fundamental need, we're going above and beyond by adding value to these opportunities. Um, like I mentioned earlier, if you're ever researching a something new and you're not finding the negatives about it, you have not done enough due diligence. So when it comes to some of the weaknesses or threats, market saturation, right? We talked about all the supply that has currently been under construction or is being delivered. We are going to still see that in the beginning phases of 2025. So there are going to be some popular metro areas that oversupply is going to be a risk on their rent growth or their occupancy rates. So we need to be mindful of that still. And then the opportunities, I've been screaming this for well over a year. Loan maturities. If you see, there's hundreds of billions of dollars worth of assets that their loans are going to be maturing, and these are going to be assets where they have to sell, or those operators are going to have to give those apartments back to the lenders. And as a lender, they only have two options. They can either work with the operator to work out something creative to refinance, or they can take back that asset. And banks and lenders, they're not apartment operators. They do not want to operate these assets. So we're going to see a huge influx of more opportunities coming to the market next year of loans that are, I'm sorry, of assets that are currently distressed. So before I move on to the threats, I just want to sort of switch everyone's perspective, including myself at one point, right? I always thought distress was just simply that. Think that is a distress opportunity, and I didn't really necessarily see the opportunity out of it. But in a distress scenario, you're going to see a huge opportunity to get assets that are going to be trading 10, 20, 30% lower than they traded a couple years ago. That is a huge opportunity to take advantage of that. And then when I think of potential threats to the multifamily market, I feel like over the last couple of years since the pandemic, we've been talking about when are we going to enter a recession? And I know they changed the definition, but like two back-to-back quarters of negative GDP sort of signifies a recession. So it's sort of like hit and miss if you think we're in a recession now, if we were in a recession a couple years back. But um, I don't necessarily like look at the news for what it is. I sort of try to like read through it. I see a lot of headlines that a recessionary period is incoming or is imminent. And during a time of recessionary periods, you're going to see higher vacancy rates, a difficulty in raising rents. Um, a potential threat to multifamily could be an elevated turmoil in the Middle East, right? we see what's going on with Iran and Israel and all these other countries in that area. Um, if there is turmoil in the Middle East, it could potentially cause pressure on the oil, which could in turn infect the supply chain issues. Also, we saw a couple months back within even the United States, along the ports, we saw the strikes, right? I think they came to an agreement, but there's nothing to say next year there won't be another strike or a potential supply chain issue that's just going to threaten the multifamily market. But that's some of my takeaways when it comes to my SWOT analysis. The multifamily market overall is strong. It's starting to stabilize. Yes, there are weaknesses with some particular metros, but we can see that some metros might have negative fundamentals, and that asset within that market could have outstanding fundamentals. Um, and just to highlight the opportunities again, we're going to see hundreds of billions of dollars worth of assets with their loans maturing. This is going to be a great opportunity for an apartment operator to acquire these assets at a reduced price. Um, yeah, so that's pretty much it for my presentation. I just want to thank you so much for your time today and hearing me ramble. I'm gonna end my presentation and then get back into the Zoom room to see if there's any questions.
That's
Uh,
that's amazing, Mike. Miles, that's beautiful, beautiful insight into the market. I learned a lot. Please, if you have questions, come in and drop it. I'm gonna have to get those slides. Miles, I learned some of those data points because it's refreshing to see that. Even though there's a lot going on in the world, the business that we're doing is thriving. So, please, if you have questions, this is the time to ask.
Great job, Mouse. You were not rambling. That's a lot of good educative
Value.
data points. So thank you so much. That was a really good presentation.
Hey, thank you, Leslie. So we just had a question from Leah. It says, "What would you say to those who are holding on to their money with current economic climate?" Um, it's gonna definitely vary between investor to investor. It really just depends on what your goal is. One thing I can say is if someone's just hoarding their money, you can't build wealth by saving. I know that a lot of people on this call today, they work hard for their capital and they feel like they have to hoard it. And I, for the longest time, felt the same way. It wasn't until I joined the Excite team where Dr. Oni mentioned that saying, like you can't build wealth by saving. It sort of flipped the switch in my mind. So um, if someone is holding on their capital, if they found an outstanding opportunity to invest in, I would tell them do like education is the number one thing. Be informed because you always want to make a decision based off information. So if you can make a data informed decision, you'll be in a great spot and you won't have that buyer's remorse. So do your due diligence, do your research. If you find an opportunity, pull the trigger because you don't want to leave this life with any regrets. Hey, thank you, Leah.
Anybody else, please drop your question. Miles is ready. I cannot answer that question. I cannot answer that question better than he just did. He's Miles, whatever juice you're drinking, I need some of those, man. It's
Wow.
powerful. Yeah, we're going to continue to bring this value to our community. Um, as you all know, we usually do this every first Monday of the month, where we pick a specific topic, bring in an expert. It's just refreshing to see how much Miles has grown in this role and the company and understanding of the market, where he's able to put data together to actually pinpoint how multi-million and multi-billion dollar assets like multifamily real estate is thriving and able to point us in a direction so that we can make informed decisions. So this is really refreshing to see. So
And then Tenny, to just add to that point, like when I first started off, I didn't know my left from my right. One thing that I learned early though is to leverage. Like we have these companies, you can Google right now, multifamily reports, and you're gonna see Barcadia, Cushman and Wakefield, Green Street Commercial. You're going to see all these people who are paying someone to do the research for us. We can leverage their expertise to just further our information, our knowledge. So that's what I'm heavy on leveraging. I leverage Costco. If I see a Costco in the market, I'm so excited because I know Costco spends billions of dollars on market research. If I see a Starbucks in the market, we're not ever going to invest solely because there's a Starbucks or solely because there's a Costco nearby, but it's like a confluence. It adds to our already like predetermined. We have certain metrics that we want to hit when we look at these markets. If it's already hitting all these metrics and I see a Costco nearby, I get even further because I'm leveraging their expertise. So just wanted to add that point, Tenny.
yes,
So,
sir.
and this just to add, this kind of reminds me of 2008, right? Because if you guys remember anything about 2008, it was an election year too. And everything was like just the news was just negative. Everything was negative, It wasn't so much negative on the election side. It was more negative on the economy side. And I remember when the market crash happened in 2008, and like there wasn't just real estate that was falling. Stocks fell to like nothing. Bank of America was selling stocks for like $7 or $4 or something ridiculous like that. And a friend of mine called me and said, "Let's buy some stocks from Bank of America." I'm like, "Nah, like the news is saying everything is going to an end, everything is going to zero," and I didn't do anything. Real estate, there was a condo here in Maryland that was selling the community. Those condos were selling for $10,000 cash. And I had about $20,000 cash in my bank account sitting there. And I didn't do anything because I was so afraid to make a move because I was caught up in the news cycle. And guess what? That same property right now is selling. Each one of those is selling for like $240,000. And the rent on those properties is almost like $2,000 a month. So I had the opportunity to buy a property for $10,000 that would that I will get rent of about $2,000 a month and appreciation right now of about 200,000. And I didn't because I was afraid. And the exact same thing is happening right now in the commercial real estate space in multifamily. You're hearing all this negativity. Everybody's like, "Oh, I'm sitting down," and the institutions are going in and they're buying. They're buying like crazy. I'm sure when
Yep.
the annual report comes out, we're gonna see it. We're gonna see it because we've had contact with some of these guys that have billions upon billions of capital, already deploying a bunch and have a bunch on the sidelines to acquire this asset. So and one of the most important lessons that we've learned along this journey is like just study the big guys, what they're doing, and you're gonna do well. So now is probably one of the best times to jump in. Shows so now
Was that me or we lost Leslie?
Yeah, and I thought it was just me on my end too, but we
Me
did
too.
lose Leslie. But to one of his points he made, like during '08, I've talked to so many real estate investors since then and family members that were like, in hindsight, they wish they would have scooped up more properties. During like a
Yeah.
time where everything is so uncertain, it really forces people to not take any action. And like, I don't know, I see it as if there's a moment where things are on sale, why not go into the market? I remember when we had Brian Burke on, he mentioned
Yeah.
real estate is the only market when things are on sale, people run away. If there's grocery store, if bananas are on sale, people are scooping up bananas or whatever
Right.
thing they want in that market. But for whatever reason, it makes sense. Like I understand it because it's by design. They don't want us to come out here and acquire these assets. They want to scoop them all up for themselves. How I mentioned in quarter two, Blackstone acquired $10 billion worth of assets. During the housing market crash, when no one was buying anything, they were deploying billions of dollars in capital, scooping up neighborhoods. So,
So the plan is pretty straightforward. It's just like you said, if people are not informed, they don't take any action. The goal is to make sure people are informed so that they use data to back the decision that they make. So there's our responsibility to make sure people are informed about what's going on and use data to back the decisions that they make. The reason why Blackstone scoops up all these deals now is they will buy it. By the time everybody gets reoriented and they come back to their senses, Blackstone is going to start offloading those deals to us. And then we're going to buy them at a high price, and then they'll wait for the market to turn again. For example, if you think about some of the deals that some people have bought, right? I bought 2006, 2007, 2016, 2017, 2018. All of those deals were sold in 2021, 2020, 2021, 2022, 2023. Some of those guys saw that the market was hot and they stayed back. They offloaded all, like Bernberg. He offloaded all of his deals. And guess what? They're coming back right now and they're beginning to buy deals. That's what they're going to go through that process of buying. And when everybody decides to say they want to get back to the market, they start offloading it, they make a lot of money. So we are basically, based on what we know now, we're like in a pivotal point where we know what's going on, we know the game. We just got to come together and actually participate in the game that they're playing, so that we can grow our wealth.
absolutely.
So I had a conversation with some of the top brokers in the market, and what they're saying is retail investors, syndicators like us, are not buying any deals. The people that are closing deals are funds. We had a conversation with one of these funds, and they have $250 million that they're deploying on assets. These are the guys that are actually transacting right now. The regular guys like us, we're not transacting right now because our focus is on the news. We're focused on the market. We're focused on inflation. We're focused on interest rate. Whereas these guys are saying, you know what, there's a little distress in the market right now. Let's take advantage of it. So especially now that the Fed has actually indicated that interest rate, they're not going to increase interest rate anymore. They're actually going to work on reducing interest rate. So it's kind of interesting that even though the Fed has indicated that they're not going to increase interest rate anymore, people are not comfortable trying to make move. Whereas the institutions already started making moves and stuff like that. And guess what? Once everybody start coming in to try to buy, what happens to price? Price start going up, and then there's going to be a bidding war again, and then everything is going to go out of hand. Anyways, great job, Miles. Appreciate the job here, and very informative session. If nobody have any question anymore, please, if you have a business you want to share with the community what your business is all about, you can come online, talk about yourself, what help we can help you, we can provide to you. Please come online and share that with us, and definitely looking forward to networking with you guys before we wrap it up. If nobody have anything at the top of the hour, we'll wrap it up. If nobody wants to share any insight or needs any help or guidance, also like Miles mentioned, we have a great deal that we're working on right now, which is an institutional grade asset. So collectively, we all have the capability of buying this particular asset. So if you've not joined the ownership group of this particular asset, please go ahead. I dropped the link on the chat as well. Go ahead and join the ownership group. The deal is a lot of people are jumping on, and we can't wait to have you join us for sure. Miles, you want to wrap it up?
Absolutely. So yeah, once again, when there's a lot of uncertainty in the world, I know people tend to not make any decisions. Definitely can respect it. But if someone has the information and they don't decide to take action, it's just it highlights us personally. So my biggest thing is let's just educate ourselves. Let's put ourselves in the driver's seat for our families because like I mentioned earlier, there's no point in me leaving behind X amount of money in inheritance to my children if I'm not providing the information for them as well. So it's our job to get the information, more importantly, to implement, because like I can learn all day, but if I'm not actually implementing, then I'm not truly learning. So I mean that's where wisdom comes in from the implementation. So let's implement. Right now is the time to invest in multifamily markets. I sort of highlighted a lot of those reasons earlier, but if you have any questions, I would love to connect with anyone. Right here is the link for the to join the Grove Park View, and I'm also going to put my contact information in here before we ride out. I would love to connect with anybody. But yeah, that's it, Tenny. I just dropped my information in the chat. If anyone wants to just copy and paste it or visit the offering page for Grove Park View, it's in the chat as well.
All right, thanks, Miles. All right, thank you everybody for joining. See you guys on the flip side. Take care, everybody.